You're listening to the Cash Podcast, creating affluence, success, and happiness with your financial surgeon, Adam Koós, President and Portfolio Manager at Libertas Wealth Management Group at libertaswealth.com.
Happy Friday, everybody. The sun is shining today in Columbus, Ohio. We're seemingly walking away from the colder months. The snow's melted. We've had a couple 60-something degree days, and I think we might have even pushed north of 70. So we're also, people are getting vaccinated. I personally might be getting vaccinated at some point here in the not-too-distant future, which I'm excited about. There was an announcement that came out, I believe, this morning or last night late, that there is a promise out there in the rumor mill that all vaccines will be available to all people come May 1st, which is not too far away. We're talking, 6 weeks, 7 weeks or so. So things are on the up and up. Things are looking good, and I'm excited, and I hope you are too, and hope you're looking forward to summer and all the things that come along with better weather, outdoor living, fire pits, sports, and just getting some exercise and working off that COVID weight, which I know I'm going to be spending a lot of time doing, that's for sure. Oh, man. Anyway, so today, this is going to be a very unique podcast because I really didn't have a topic teed up, to be honest. I was putting together something else, a private video for our clients only, which could be going out to our clients right now as I'm recording this podcast this morning on Friday, March 12th. And so as I was recording that private clients only video, I started thinking last night late before I went to bed, what am I going to talk about tomorrow on the podcast? So I probably could have put a whole lot more thought into this, but on Fridays over the weekend, and especially on Fridays and Mondays both, I spend a bunch of time doing research where I go through my routine. I go through the stock market, the bond market, the commodity market. I look at breadth indicators and intermarket relationships and all kinds of different things that I've put together that I guess make up my routine. And I thought maybe it would be fun to, as opposed to having some sort of, agenda or PowerPoint, so to speak, to just kind of let you in on a bunch of the stuff that I look at. And I'll try to kind of explain it as I go here and provide some education that way and let you into my nerdy research room, so to speak. So kind of a behind-the-scenes look at what I'm going through on a day-to-day, week-to-week, and month-to-month basis. But before I do that, as always, just a few housekeeping items. If this is your first time listening or watching, thank you so much for joining us. The Cash Podcast is produced weekly, and as stated in the intro, CASH stands for creating affluence, success, and happiness, and that's our mission. My hope is for you to learn a little bit more on each and every episode so that you become more successful, wealthier, happier, and more educated than you were before you started listening today. So come back often. Feel free to subscribe both on iTunes and YouTube so that you get updates every time we record a podcast or a video. And in addition, you can also follow me on Twitter at Adam Koós and on Instagram at Financial Surgeon. Last but not least, again, this is going to be a unique episode, so all links, visuals, charts, and other educational resources are going to be available on our website. And I'm going to do my absolute best to talk the iTunes listeners through what I'm looking at, but I am, just to be straight up, I'm going to be going through a bunch of visuals and honestly way too many visuals to be snagging, copying, pasting, and throwing on our website as screenshots. So I do apologize to our loyal iTunes listeners. I know we've had several requests over the years to have our charts and so on posted on the website, and we almost always do that. But like I said, this is going to be a very content heavy. I don't want to say I'm going to go overboard here, but this is going to be a very content heavy episode. So I wanted to make sure that you knew that in advance. All right, so here I am. I use a couple different pieces of research, or a couple different pieces of software, I should say, when I go through all my research. And probably the one I use the most is a piece of software called Optima. And if any of you have ever done anything, whether it's, I'll use a couple analogies here. If you've ever, if you've ever written music before, like I have a music studio in my basement. When I write music, it starts kind of like this, except none of the workbooks on the left here. So it'd be a blank slate and you pretty much kind of start with nothing and you say, okay, I have an idea. And then you start putting these ideas together, and eventually, before you know it, you've added a kick drum, a hi-hat, a snare drum, a bass line, maybe some strings, a guitar, and I don't know, an hour and a half, 2 hours later, you've got a song. So that's one example. For those of you who maybe have ever done any kind of video production, if you've ever used iMovie on an Apple, or I think there's Windows Movie Maker, you open up the program and there's nothing there. It's just blank. You start adding pictures, videos, you add music, and before you know it, you've got a video. The same could be said if you're a writer, or if you've ever, obviously most of us listening or watching have written a paper before. If you've ever written a paper or a book or a research report, obviously back in school, we all wrote papers. So when you start that paper, you start with nothing. Then maybe you build an outline, and from that outline, you actually write the paper out, then you review it, edit it, and it gets submitted. So with this piece of software, Optima, it's kind of a blank slate where you have to start with nothing. I shouldn't say have to start with nothing. That makes it sound bad. It's quite the opposite, actually. This software is so unbelievably powerful that I can throw anything I want at it. And even if, let's just say, there's an indicator or something that I want it to do, or something that I want to show me, or I want to program it to do something for me that I just came up with. I just had an idea, and I said, hey, I want to see, how many times has the 5-day moving average of the S&P 500 crossed below and above the 200-day moving average on the S&P 500 since World War II, and then plot that on a chart with lines. You can actually code it, and this software is so powerful, as you're about to see here. I'll show you some things. It does it in a matter of seconds. It's insane. So this is one of the many tools that I use, although I use some more heavily than others. What I'm going to show you today is Optima and a bunch of my workbooks, and then I'm also going to show you a piece of software called MarketSmith that I use quite a bit as well, which is made by a company called Investors Business Daily, and Arusha Paris, who's a friend of mine who heads up the MarketSmith division over at IBD. So we're going to go over a little bit of that too. But anyway, so let's just kind of pull up a couple things. The first thing I always look at when I look at my research, when I'm wondering what's going on with the market today, is what I call my pre-flight checklist. And this is just a big, huge set of indicators that starts with the S&P and the NASDAQ, and we're looking at whether or not the 5-day moving average is above or below the 200, the 8-day moving average is above the 21, whether or not the 21-day moving average is sloping up or sloping down, and whether or not the market is above or below the 8-day moving average, which would be all short-term stuff. Then it goes intermediate term, and the indicators get longer, and then you go long term, and obviously we get even longer. We're looking at weekly indicators and not even daily. So daily would obviously be short, and then of course shorter term indicators on the daily charts would make it really short. But then when you start looking at weekly, it really starts to extend things out into the future. This is just a chart of the S&P 500 down here. Let me turn off my crosshairs. And then on the right here, I'm not going to go over all these details because I've built this along with the help of Optima. We've coded this. Me and some friends of mine in the industry literally internationally have helped me kind of build this over the years, and so I don't want to go over too much detail here. For those of you who are technical analysts, you'll be able to figure it out pretty easily, I'm sure. But this is an elder candle system using bars. But anyway, so these are all. I call this my weekly pre-flight checklist, or my daily pre-flight checklist, and I kind of stole the name from Dave Keller, who was the head of technical analysis at Fidelity, a good friend of mine who's he works for stockcharts.com. You could probably see his videos there, but he's a pilot, and he came with this concept of looking at every day you open up your workbook or your research, you say, is it okay to be investing in the market today? Is it okay to be taking new entries? So right here it says safe for new entries. We want to look at, what's the health of the market today? Is it okay to add new money today? Is it okay to stay heavily invested in the market if you're in a trend following portfolio, let's just say? So, and here at our office at Libertas Wealth Management Group, we manage both strategic buy and hold, asset class rotation, sector rotation models. So I have four sector rotation models that are more buy, hold, static, we'll call it, that stay in the market. And then I have four tactical trend following models. There was a time in my career when all I did was manage strategic buy and hold, static, relative strength based sector rotation models. And then after the '08 crash, I strictly went to all tactical trend following, and that was it. And then this past year after the Corona crash or COVID crash, I reintroduced the strategic models, and we're managing both now. So we have something that's working all the time when you consider the fact that the market has gone down. It went down so fast last year. It went down 35% in 22 days, which was the fastest crash in U.S. history. It made sense as this market continues to speed up, and who knows if it'll continue to stay as fast as it's been or not, then we need to have something that's working all the time. You need to have strategies that can work in a market that's very fast and whippy or whipsawy, if that's a word. It's probably not. And some people may need to have portfolios that are also going to work really well in a slow grinding environment. So for what I mean by that is if we own a portfolio, or if our strategy is more buy and hold, sector rotation, asset class rotation, industry rotation. So I always like to call it, when in all of these models that I manage, I want to stay invested in the playoff teams. So, whether it's basketball, football, the Olympics, it doesn't make a difference. We don't want to invest our money in every team and every player in every sport. Obviously, that's broad scale diversification. What we want to do is we want to concentrate our money, not so much that we're putting all our money in one stock, obviously, that goes without saying, but we want to concentrate our money within the playoff teams, so the best of the best, and we want to avoid the rest. So, and then over time, there's times when those playoff teams, those good players or good teams will lose games. There's going to be times when they lose a couple games. They go on a losing streak. But just because you lose a game or two doesn't mean that you aren't a playoff team anymore. It just means that you're having a bad streak. Now, of course, if that streak turns into a problem and all of a sudden now we've got a losing record, when I say we, I mean the team in question or the investment in question, then at that point, we need to start talking about replacing that team with another one that looks a little bit more like a playoff hopeful team, if that makes sense. So everything that I manage in all of our portfolios is based on relative strength, first and foremost, and staying with the leaders, those playoff teams, and again, avoiding the laggards. So, and then we've got the 4 models that are strategic, static, buy, hold, rotate, stay in the playoff teams, and then we've got the ones that are tactical that not only stay invested in those playoff teams, but they also will get out of the market and raise cash when things when we start to see tornado sirens and severe weather on the horizon. So anyway, so that was my pre-flight checklist. That was probably a little bit, I don't know, I was probably a fire hose to start this podcast, to be honest. So let's look at an RRG. This is fun. So Julius de Kampenaer, a friend of mine and over the Netherlands, invented this a long time ago. When I say a long time ago, we're talking, he probably invented it 12 years ago, maybe 11 years ago at this point. Presented it to Bloomberg, I believe it was in 2011. And now you can pretty much find relative rotation graphs on, most research softwares anyway, and the good ones anyhow. And what a relative rotation graph is, and I'll pull it up here. No, that's not it. All right, so here we go. So what we have here in the upper left quadrant, and if you're listening on iTunes, picture a 4 squares, put together and with an X and Y axis. You've got upper left, which is improving versus the market, upper right, which is leading the market, lower right, which is weakening versus the market, and lower left, which is lagging or underperforming versus the market. The market is right here smack dab in the middle at the 0 point on the XY axis. So we can put any benchmark we want here. As you can see on the left, I put comparison index, that's SPX, it's the S&P 500, and then the circle right here is a multiplier. I'm just basically said I don't want to see any stocks that are within 2 standard deviations of the middle, because I want to look at stocks that are moving. I want to see stuff that's really kind of either really outperforming, or in the case of say Tesla, as you can see down here, it's in the weakening sector and it's moving very, very quickly. You can see every dot on this arrow tail is 1 week, and that shows the velocity increasing as it heads into that weakening category from leading, which is where it spent quite a bit of time. Now, if I zoom in here, let's look at some leading stuff first. So some stuff that's doing really, really well would be things like CarMax. CarMax has been doing well. Valero Energy, a lot of the energy stocks have been doing well. Twitter, believe it or not, Twitter it had a rough time for a long time, and now it's been doing extremely well. We've got a lot of the oil stocks like Diamondback Energy and Occidental Petroleum. This is Marathon Oil. And then up here, way up in the upper right, the big outperformers, Viacom, Discover. It's the companies like this. I believe this is Apache right here. Nope, I'm sorry, APA. AMAT, which is Applied Materials, is a stock that I've followed for years and years and years. But you can see here how a lot of these stocks are starting to curl down into the weakening category, which is basically indicates that they're starting to weaken versus the market. They're coming out of that leading category into the weakening category. Now, you look at the bottom left here, so the bottom left quadrant, these are the companies that have gone into the lagging quadrant. And for those of you that pay a lot of attention to the market, that watch market news, CNBC, any of you who are really interested in the details, I guess, and kind of pay attention to this stuff, you probably know that a lot of this is going to make sense. When you look at a lot of these companies like Qualcomm, Take-Two, Autodesk, a lot of these companies have been, in the tech sector especially, have been really struggling. So that would make sense that you see them curling down here into this lagging quadrant. But what I'm going to do here, I'm not going to animate this, but I'm going to show you something. This is really cool. So what Julius did, and when he built this relative rotation graph concept, is he was the first person, and I believe still the only person, to prove visually that this concept of sector rotation, industry group rotation, and staying with the winners, the leaders, the idea of investing in the playoff teams and avoiding the rest, and how much sense that makes. So this is a slide bar up here that I can go all the way back, and I can take it, in this case, back to 2016. But watch this. So if you're listening on iTunes, I'll just tell you what's happening here, but I don't want to blow the punchline to the viewers. So as you can see, every time this ticks is 1 week. And I know this is a recorded podcast. This isn't live, and I can't get any feedback right away. It's not like I'm DJing a party here and I get immediate feedback. You have to be watching this RRG going back to 2016, this relative rotation graph, and tell me what it is that you see. What do you notice about the rotation of these stocks? This is all 505 stocks in the S&P 500 going back from 2016. Here we are, we're about to go into 2020, and the better performers are companies like Tesla, Etsy. Look what happened. Now we have in early 2020, when that COVID hit, all these companies start tanking. Companies like oil stocks, energy stocks, obviously companies that aren't going to do so well if everybody's locked down, stuck at home, right? But what starts doing well? Some of the leaders that start coming out are things like Regeneron Pharmaceuticals. We start seeing companies like Etsy, people buying gifts at home. We're sitting here in June. On June 5th, the best performing stocks here are companies like Dexcom, which is a tech company. Newmont is kind of curling down. Regeneron's still up there. eBay, PayPal, Chipotle. No matter how much they try to lock us down, we will not stop eating Chipotle, apparently. But you can see now that for the people listening on iTunes, what this is doing is it's curling and rotating in a clockwise fashion. So as you were watching this, if that's what you were thinking, you are 100% correct. I'll go a lot faster this time. The relative rotation graph rotates generally about 70% of the time in a clockwise fashion. So pretty neat tool, and I'll stop talking about the RRG today, but that's one of the tools that I look at on a really frequent basis because it's really helpful to get a nice visual image of what's going on in the market today. Let's see, what do I want to show you next? Let's look at, let's pull up my breadth model. And I'm not going to go into too much detail here because breadth is not, it's not breadth, it's breadth. It's participation. It's the concept that, the S&P 500 is a cap-weighted index. The largest companies on the index, obviously, produce the biggest movement up or down in the stock index. So if all the big companies on the S&P 500 go up, but then there's a ton of small companies going down, you're not going to see it. At least it's going to be very difficult to see because we like to call the big large cap companies the generals. They're kind of going into battle. When the market's going up, you want to have your troops marching right behind you into battle with you. You don't want them retreating and running away. That's one of the first signs that a market is not healthy, and that we're in trouble is when small companies are not doing well. When small cap stocks are underperforming, running away, retreating from the generals, and the generals are running into battle, about to hit the front lines, and they turn around and there's no one behind them, that's a problem. That's a problem for the stock market as an analogy here. What you're looking at here, and for the iTunes watchers or listeners, this isn't really all that interesting to look at anyhow, but this is a 12-month rate of change, just comparing small cap stocks to commodities, to large cap U.S. stocks, to international stocks, to money market, and to bonds. And when you look at the 12-month rate of change or 12-month relative strength ranking here, what we're looking at is IJR, small cap stocks, very clearly in the leading position, which tells me that the market, it'd be pretty difficult to have an unhealthy market right now in the short and intermediate term if small cap stocks are showing up as the leader, the leading cap and style inside the stock market. Number two are commodities. Commodities have been doing well. Obviously, we're starting to see the probabilities pick up of more infrastructure here in the U.S. Then the number three ranked asset class here is U.S. stocks. Number four is bonds. Number five is money market. And if you've watched any of my previous podcasts or listened to them, if you've read any of my recent articles, I've talked a lot about how traditional bonds have not been a great investment. And traditional bonds have been something we've been relatively, for the most part, avoiding this last few months, with some rare exceptions, because they've just been really, really struggling. As interest rates go up, bonds go down. When interest rates go down, bonds go up. What have interest rates been doing lately? They've been going up. So as a result, your traditional bonds, 10-year treasuries, 20-year treasuries, they've been going down. Which is probably fooling a lot of people who have got it in their minds that bonds are safe, period, and bonds don't go down. Well, as you can see very clearly here, bonds do go down. So let's see if I can get a quick. Well, I'll go to my playpen next. I'm going to pull up that playpen's just a bunch of different indicators and charts and stuff that I like to play with that don't really have any organization whatsoever. So let's look at TLT. So TLT is the 20-year Treasury bond ETF, so exchange traded fund. It's 20-year bonds. You can see here, and I'll show you the percentage change just since. Actually, wait a minute. I need my crosshair. So if you're listening on iTunes, I'm starting back here in August. Since August, long-term bonds, 20-year treasuries, are down 20.7%. How many of you, and again, I don't get any feedback here, unfortunately, but how many of you, if you're listening or watching this, can imagine, or if you were asked, I've got 5 investments, one of them's down 20%, one of them's up 20%. How many of you would guess that the one that's down 20% in 7-8 months is a bond, a United States Treasury bond, no less? So that's really interesting. If let's see if I can go back further here. Yeah, it looks like the peak. That's just about the same. I'm not going to count this candle right here, but let's see if we take. Yeah, they're about the same highs. I was curious if the highs in April were the same as the highs in August, and they are. So long term, Treasury bonds here in the U.S. were peaked out in April, shortly after COVID started. They bottomed in June. They peaked out again roughly at the same spot. I don't want to call that a double top. I don't have the right indicators up here to say so. But and then we can see here how it fell since August. Like I said, down more than 20%. In fact, I was actually looking to purchase these bonds, and let me see if I can get a chart up here. Well, here I'm gonna. Well, by the way, if you're watching, you're looking at the bottom here. This blue and red down here is the percentage that the investment, in this case Treasury bonds, are above the 50-day moving average. The 50-day moving average is the average movement of an investment over 50 days. That's it. Just kind of smooths things out, gives you a better idea of trend. And the blue here tells us that we're above, as you can see, above the 50-day moving average. As soon as it crosses below it, it tells us what percentage we are below it. And that's one of the many cool things about Optima. This software is so nice. We could just plot this on here and see very easily, where are we at from a percentage standpoint, below the 50-day moving average currently, or above it for that matter, and then kind of look at different ranges and averages and make decisions based on that information. But anyway, what I was going to show you here Turn off that, and I'm going to turn on RSI. So one of the things I liked, and we'll see what happens today, it's going to take the bond market, the Treasury bond market, closing, well, I don't say a lot higher, but definitely higher, in order for this divergence to still be valid. But one of the things I've been watching since last week is this divergence upward between momentum. So this is RSI, momentum. You get a lower high here. I'm sorry, a low here and then a higher low here in RSI, which is momentum. So that's a higher low, while you've got a lower low in price, in the value of the bonds. And the reason that's important is when you start to see divergences, in this case a positive divergence, where momentum is signaling higher lows while price is going down, it's a hint or a clue that perhaps maybe we're starting to see a bottoming process in bonds, and that if you were to take that trade, you might say, well, I'm up here, the bond market's chart about 138.94 on the TLT. Maybe I buy it and I put a stop. I'll put a trend line down here. I put a stop right here below that most recent low. So there we go. So if I put a stop below that low and it falls below that low and it closes below there, or if you want to be more aggressive and you want to say, I'm not waiting for a close, I'm just selling it, period, which today probably wouldn't be a bad idea if you took that trade, then you'd be out and you wouldn't be playing in this game anymore, obviously. But this did look like it was promising, and it's not invalid quite yet. Again, if the bond market were to close a little bit higher, or if it closed where it was today, and then it started creeping higher again, we might find ourselves with a different higher low in RSI on bonds, for instance. Monthly charts. So monthly chart, you can see here, this is an old trend line that I'd drawn across RSI. This will be a negative divergence, So if we have higher highs in price, so the market's going up, but we have lower highs in momentum, that is a hint that the market could, or at least there's higher probabilities, we'll say, not certainties, but probabilities, that the market could correct or could pull back down. And but since this is a monthly chart, every one of these candlesticks is 1 month, which makes it very, very long term. So a divergence that starts all the way back in January of 18 that ends down here in August of 2020 would be obviously a really, really big divergence if it were to follow through. And if it had followed through, which it did not, by the way, then we would have or should have seen stocks, the S&P 500 in this case, fail somewhere in the ballpark of November, right around the election, and then start to tank from there. And I shouldn't use the word tank. That's a little dramatic. But anyway, so that's what should have happened if this RSI clue or hint were valid. But as you can see, it broke out above that downtrend line, which negated the negative divergence in long-term monthly charts. So that's a sign that whenever you get a sign that it looks like things are bad, or there's bad indicators or negative signs, and when it comes to different indicators and charts, and then they become invalid, they're invalidated, that is not bearish. That's good. It's good for the market. So I think it's important to understand that sometimes many people are looking for feedback. They're looking for something that supports of, say, a positive opinion. They'll look for research and they say, oh, look, that's positive research. Maybe that's a sign that things are going to go well. And then when that doesn't work, that's information. That's good information that says, well, I thought that things were going to look well, but this is telling me the opposite. Or in this case, it looked like the market was going to tank, or might tank. There I am being dramatic again. And as we see this RSI divergence, this momentum divergence play out, and market keeps going up, getting frothier and frothier and more long in the tooth, I expect that we should see a big pullback at some point. But then RSI says, nope, we're going back up again, and we'll see what happens if we cross back above 70 here, which would be bullish as well. But we already have a negated negative divergence, which tells me, that indicator turned out to be wrong, and the market's actually just going to continue up, and it has continued up. So let's see here. What else? AD. Oh, this is good. This is really, really, really good. So this is educational here. In the top pane, we have the S&P 500. The market's going up, right? We've had a correction here, about a 10% correction, 8% correction. Just recently on the S&P, we had about 4% pullback. The NASDAQ had more of a 10+% correction recently. But looking at the S&P 500 in the top here, this is just the value of the market. And you can see the market's going up. If you look at the bottom pane here, and for those of you watching on iTunes, it looks pretty similar, not exactly the same, but very similar if you're listening on iTunes to the market. The AD line. AD stands for advanced decline, and all it is the advancers minus the decliners, and we want to see how much participation are we getting out of this market. If we were seeing this go down, so if the AD line was going down, that would mean we have more declining stocks than advancing stocks. Remember, the S&P 500 is a cap-weighted index. So is the Dow. The Dow's all large cap stocks. But when you see the S&P 500 going up, you have to dig deeper and say, okay, just because it's going up, what are all the stocks in the S&P doing? Not just what are the big stocks doing, because that's all the S&P tells you and shows you is what the big cap stocks are doing. So if you drill down deeper and you say, well, what are all the individual 505 stocks doing on the S&P 500? What you want to see is the advanced decline line confirming higher prices in the S&P. And that's exactly what we're seeing here. In fact, I don't know if you can see this if you're watching on YouTube, but I'm going to draw a horizontal line here. S&P hit that previous high from February, just literally this week, and then I'm going to draw another horizontal line at. Actually, hold on, I need my crosshairs here. I'm going to draw another horizontal line at the AD line. So here's the high from February, similar high that we saw in the S&P 500 index. But look. The AD line, the number of advancers, is actually higher, so it's broken out to new highs before the S&P 500 did. That's good. That's telling us that the stocks inside the S&P 500 are actually performing better than the cap-weighted index itself. Excuse me. You can't. I don't want to say there's nothing more bullish than that, but that's definitely not negative information. That's good information that can help us keep a clear head and realize that, okay, if the market's pulling back, it's just a pullback. Maybe in my trend following models, maybe I want to raise a little bit of cash, which is fine, but maybe we don't want to go all the way to the locker room and into the bomb shelter, necessarily speaking. All right, I'm going to skip this. I think I should probably end here pretty soon because I don't even know how long I've been talking. So this is truly behind the scenes in my nerdy research room here because I don't even know how long I've been talking. So how about that? Let's see if and maybe I'll show you one more thing here. This is what I'll leave you with. This is going to look ridiculous, but I want to show it to you because I think it's interesting. So this is for the fellow nerds out there. You're going to look at this and you're going to see that this is a correlation analysis immediately. You're going to look at this thing and go, that's a correlation analysis, and you can see all the way over to the right. What I'm doing is I'm comparing, in this case, an inventory of ETFs to themselves, to find out if there's any correlation or high correlations between these different investments so that I don't have, two investments that own the same stuff. I think there's one of the big mistakes that some people can make is they can buy 10 investments, say mutual funds or ETFs, and not realize that all 10 investments have an overlap of, call it 95%. Now, I know I mentioned earlier that we don't want to just buy every team in the NFL or every team in March Madness. We want to own the best teams, the top seeded teams, the playoff teams. We don't just want to own every team in sports because obviously that's broad diversification. So I just said earlier that we should be concentrated. We want to narrow down. We want to be concentrated. But there still is a level of diversification that we want to have. Right now, we want to be invested. Let me pull up. Let me pull over MarketSmith here. We want to be invested in things that are strong. So, when I look at things that are strong right now, this is the S&P 500, but here's basic materials. So material stocks. These are doing well. They're very strong. This RS rating is proprietary to Investors Business Daily and MarketSmith, but this is basically saying that based on their proprietary metric that measures relative strength, that this particular investment is outperforming 73% of all investments, period. If we go next, this is consumer cyclicals, which is the opposite would be staples. Staples are things we need, our razors and our milk and things like that. Consumer cyclicals are discretionaries. They're the things that we want, the luxury goods. So you can see here that this investment is doing really well. Industrials, kind of back to the whole idea of construction, industrials, and things of that nature. Here's energy, and not only is this energy, but this is a momentum portfolio where we're inside of this basket of investments is an additional momentum filter that stays invested in those playoff teams within the energy sector. This is just small company discretionary, so luxury goods, but small companies doing really, really well. This is steel stocks. Actually, let me back that out. So these are steel stocks and stocks in the steel industry. This is, again, energy, but this is, again, small company energy stocks. You can see a lot of that small company stuff's doing well. And if we go back to that, which I won't, but if we go back to that chart, the AD line, the advanced decline line, compared to the S&P 500, this is the kind of stuff that's causing that AD line to go up before the S&P, is that you got your small cap stocks doing well. Then we've got things like blockchain. Blockchain. When you think of blockchain, you think of things like Bitcoin and Ethereum and Litecoin and so on and so forth. So that's been doing well. Then there's some individual stocks here, like Haverty Furniture. People spend a lot of money remodeling their homes, replacing furniture, buying toys like boats, watercraft of other kinds, four-wheelers, luxury items in that respect, because they couldn't travel last year. Now, I don't know how long that's going to last, because as we go back to an open economy, I think that we're going to continue to see a trend of some of the old stocks that weren't doing so well starting to pick up steam instead. But Cinex here, this is an electronics company doing well. Callaway Golf is a company that's been doing very well. They also own Topgolf. So if any of you have ever gone to Topgolf and played, whether it be winter, spring, fall, summer, doesn't make a difference, all season golf. And here in Ohio, we love that, because unlike those of you who are in the South who can play golf anytime you want, we can't exactly do that, or at least it's really difficult in 2 feet of snow. We got Ashland here, Ashland Global Holdings, which, it doesn't have as good of an RS rating, but what I really liked about this particular stock was the fact that you had this nice wide base here and this kind of, accumulation that's occurring. When the market's up, we want to see high blue volume bars, and when the market's down, or in this case, the stock, Ashland, when Ashland's down, we want to see smaller red bars. So on the days when a stock or the market is doing well, we want to see big volume. If we see small volume on up days, that's bad. And when we see down days in a stock or down days in the market, we want to see small volume, which, we want to see buying enthusiasm, strong enthusiasm, momentum, and so on and so forth. So last one here, I'll show you a couple more here. Lyft. So Lyft, the competitor to Uber, looking pretty good right now. Nice RS rating. Here's SC. This looks really good. Again, lots of high blue days, so positive days on big up days. The red that we're seeing here, so the negative days have been relatively muted on a volume basis. And then here's last but not least, a mining company based out of Canada, but they mine silver properties in Mexico. And this is kind of, it's spiked up, pulled back, bounced again, and now it's kind of settling in here above its 50-day moving average. But when you look at things like earnings and sales down here in the bottom right, there's over 1,000% increase in earnings, 21% increase in sales, and then after-tax margin. When companies are paying more in tax, that's a good thing. All right, I think I'm going to end today because, like I said, I'm afraid to stop this recording and see how long I've been talking at you. So you all know how to find me. If you, well, I shouldn't say that. If you don't know how to find me, please know you can always reach out if you have a question about anything at all. If you want a second opinion on your portfolio, or even if you just want to nerd out with me and have fun looking at this kind of stuff. I love going through all this analysis and playing around with research and things of this. I always say I haven't worked in 2 decades. This has been fun. I've been very fortunate to fall into a career that I love so much and really enjoy getting up every day and going to work. So, but that's it for today's show. So please feel free to share this episode with your friends and family, as long as it's not going to put them to sleep. And if you'd like to discuss your personal situation further, please remember that you never have to be a client to ask a question. If you'd like to set up an introduction call with me or a Zoom meeting, just head over to our website to schedule something in our calendar. As I always say, there are thousands of podcasts out there, and you chose to give ours a listen today, so thank you so much for tuning in. Be sure to subscribe on iTunes and YouTube, and remember, you can always sign up at our website at libertaswealth.com to not only get these updates, but we also have articles, videos through our Libertas YouTube page, as well as articles that we write that could be delivered directly to your email inbox, in addition to signing up on YouTube and iTunes to get these updates. So feel free to follow us as well on Facebook. I mentioned earlier I'm on Twitter at Adam Koós, as well as Instagram at Financial Surgeon. So thank you so much once again for joining us, and we will see you next time.
Thank you for listening to the Cash Podcast with your financial surgeon, Adam Koós. To see any charts or images that were mentioned in this show, or to check out additional articles, videos, and other educational resources, head over to libertaswealth.com.